I'm going to start by saying that there are many different ways to invest. If what you're looking to do is achieve above market average returns, there is perhaps one common element that can be drawn out from all the different ways you can look to achieve that. And that is being different is good. So perhaps I'm going to go through as a starting point, what are the areas that in investment you can start by trying to be different from the majority of the market. Well, the first is be long-term. And by long-term, I mean measure your time horizons, and if you can invest on the basis of years rather than months or weeks, that's a good place to be. Turnover data in markets suggests that shares are being held for shorter and shorter periods. Actually, when we look at the pressures that publicly listed companies are under to talk about their quarterly earnings targets, it's clear that the time frames in which people evaluate the investments are even shorter still. If you can be long-term in your approach, you can turn time and volatility to your advantage. And that's actually quite important, because volatility, I'm going to suggest, relative to a market average, is very different from what we've already heard us talk about, the permanent loss of capital that Warren Buffett focuses on. The second is be global. Don't follow benchmark convention, follow what companies are doing. Companies are increasingly global. Where a company chooses to list its shares on a stock exchange might not tell you anything about where it generates its revenue and its profits from. Sitting here in the UK, we're already well aware that that can be the case. The other area is be a true growth investor. Well, why is that? Well, that's because over a period of years, if a company can grow substantially faster than the market, if it has a competitive advantage in doing what it's doing that allows it to grow much faster than the average company, then it should, all other things being equal, give you the opportunity to produce strong returns. That's not to say that over shorter periods of time, concerns in markets, macroeconomics, might swamp share prices. Well, that's your opportunity to take advantage of short-term volatility. If fundamental company analysis is telling you that there is a disconnect in the stock price to what that company can achieve because, let's say, it's a European company and we're worried about what the ECB is doing, then that is your opportunity to buy. But that's quite difficult, and we'll come back onto that. But being a growth investor, a true growth investor, is actually, I'm going to suggest, quite a lonely place to be. Lastly, it must be clear by now that if you're going to do this, you need to pick the individual companies. This is about stock picking analysis. This is not about looking at an index relative position. And the only way that you can do that is by active management, especially when you consider how many companies there are across the world. You can't possibly put all of those in your portfolio and expect any one to make a difference. Why does this matter? Well, there are a small number of companies, if you look at long-run market returns, that make a true difference to the returns generally available from investing in just the market. The middle part of the companies tend to wash each other out. So some do a little bit better than the market, some do worse than the market. There are one or two that go bust or suffer really strong share price falls. But there are about 5% that can make you a multiple of your initial investment if you are a patient long-term investor prepared to hold through the difficult times when macroeconomics might swamp them. And this is based on our portfolio, and you can see that some of the holdings that we've picked, I'd highlight Amazon, and I'll come on to talk about that shortly, and there's Apple, Alibaba, the Chinese e-commerce equivalent that's roughly doing the same thing but in China as Amazon, have made us several multiples of our money. You have to accept that if you are investing on this basis, there's inherent uncertainty, there's an inherent risk. You can lose a considerable amount of your capital. That is the true risk, the permanent loss of capital. You need to accept that within a broad portfolio, there is room. If you want to own the top earning ones, you have to accept that some will fall. But as you can see, the balance and the asymmetry means that getting just a few of these right more than make up for the mistakes you have at the bottom. Fundamentally, though, as I said, this is all about stock picking. It always comes back to looking at your companies, doing old-fashioned analysis, ask them, what's the competitive advantage? Why are they better than somebody else? Are they doing something different? either because it's genuinely new, it's a new technology. Are they challenging an old established industry by using new technology to do something very differently? Why do they have capital strength enough to keep them going through the difficult times? Do management agree with your assessment? Because if you're investing for the long run and management don't agree with where you think the potential is, over 5 years and beyond, management can kill a good opportunity. So you need to talk to your companies, and there are 1 or 2 extraordinary individuals in the world who are really doing something different. First person you might recognize is Jeff Bezos, who is the founder and leader of Amazon. He is very much a driven man. I would encourage you, if you do read one annual report, I'd only read the first few pages that have the commentary. If you're going to read just a few of them, they repeat the commentary from 1997, the first year this company listed, back when it was a small book retailer. People didn't think it would challenge the might of Barnes and Noble. If you read that annual report, it'll become clear that Amazon's ambition was always far, far greater than that. It was to be that everything store, because this is a company that has not given up its drive despite the size it's already reached. E-commerce has a lot more to go, but even in the US market alone, which is Amazon's largest market in just the e-commerce alone, it's still only a fraction of US retail sales, but it's offering customers something different. It's offering them a better experience. It's not as much fun to go and traipse around Walmart. If somebody will deliver it to your door, and they're aiming to do this now in matters of hours rather than within 24 hours, that's a better proposition. They're using their scale to do that so that it's cheaper for you. What they've done is build a niche market in one area and take cash flows from that to invest in the future. And we've seen that all the way home. And that really is down to the vision of the management and an alignment with management with the time horizons of investors who are prepared to look at company fundamentals out a few years. Jeff Bezos noticeably will not talk to investors, to Wall Street, about quarterly earnings targets. Amazon, if you look at their share price, is incredibly volatile. I can't tell you when they release their earnings results, whether they'll go up 20% or down 20%, or who knows. I can say, look at what they've done over time as they've grown their business. That's archetypal of what we're looking to do for Scottish Mortgage. This is Jack Ma. I mentioned Alibaba. Alibaba is doing much the same thing in China, but China lacks the physical infrastructure of bricks and mortar retailing. They have about a 70% market share of e-commerce in China, but there's still half the population without internet access. This is really doing something exciting. The power of their network meant that when they launched a money market fund, within 18 months of getting the banking license for it, they became the 4th largest money market fund in the world with $90 billion under management. That is the scale that some of these companies can reach. When you look at the prospects for the future, these companies have much, much further to go and are the dominant players. Sure you all recognise this gentleman. So Mark Zuckerberg is archetypal of, again, the sort of thing we look for in those running our companies. Are their time horizons? Are their ambitions aligned with ours? I'm fairly certain that Mark Zuckerberg never needs to work another day again in his life. He's there at Facebook to do something different. And the true genius of what he's doing is being prepared to invest not only for next year or 5 years hence, but through his acquisitions of the likes of Instagram that gave imaging capacity, through WhatsApp for the messaging services, and perhaps through Oculus Rift in virtual reality. He's investing 5, 10, 15 years into the future, maybe even beyond. What he's doing with that company is truly disruptive when it comes to advertising, because if you look at the feedback that's available through these companies, it's truly astonishing, and it's just at the cusp of what's starting, despite the size it's already reached. Lastly, this is somebody you've probably never seen, but I bet you all know his companies. This gentleman is Amancio Ortega. He owns Inditex, which owns the likes of Zara, Pull & Bear. It's fashion, it's fast fashion. It's unusual in that it's based in Spain, in Galicia, Spain, not at manufacturing out in the east. They manage the most of it through Spain. What's important here is that he recognised this is about logistics as much as it is about fashion. They can turn ideas round much, much faster than most other retailers. They take feedback from their stores with the revolutionary idea that you should give customers what they want, not make things and then try to persuade your customers that that's what they want to buy. So in terms of where are we excited about as investors, what might drive returns in the future, and just to give you some ideas to think about when you're thinking about your own investments. It's clear that the e-commerce trends that we've seen, we've talked about 2 of the companies there, the social media trends are already established but have plenty of room to go. The changes that have come through the power of the internet, and here it's not just about connectivity, but it's also about the data that then comes back, the deep learning that comes through machine learning and AI that allows you then to take your data that you're getting back and offer your customers something better is quite important. But there are new areas where this is impacting. And the first of these is using that data processing in healthcare. We all know that healthcare needs to get better. It needs to be more targeted. We need to make sure that the treatments that we give work in the people we're giving them to, and we need to stop wasting costs. The progresses in genetics pioneered through the cost curve of the human genome sequencing falling to an area where you can apply it in a clinical facility has been really key to driving this. And the company behind that is one of our largest holdings. It's run by a gentleman called Jay Flatley, and it's called Illumina. And they've brought down the cost of a full human genome sequence to under $500, and they're supporting the 100,000 Genome Project here in the UK. What that's allowed to happen is a number of treatments to look from coming out of the academic sphere, moving into a clinical application, starting clinical trials. This is very much at the beginning of where we are. If you speak to the scientists, they are very much excited by it, but also very wary of saying, this could be curative. This isn't about moving something into palliative and a chronic condition. This could be curative. It's very exciting, it's at the cusp, and this is going to make a huge difference when you think of big pharma companies who own big patent drugs that they just give to absolutely everybody without being able to tell which part of the population they work in. That's going to radically change the cost structure we have in healthcare. The next one, you probably recognise, is a Tesla car. So transportation has a number of things happening in it, but by far and away the most important company is Tesla, run by Elon Musk. We think the recent release of the Model 3 that is going to come into production in 2017 is a true game changer. If you think about this company from an investment point of view, it's able to double its sales, moving from the Model S that already is here to the Model X. It's making the future investment through the Gigafactory that allows it to scale up its production. Those are both high margin, but relatively small production and demand runs. The Model 3 gives them the access to target a market that's akin to Audi A3, Audi A4, the BMW equivalents, and Mercedes. That's a much larger number of people. And when they released the Model 3 for pre-orders, within the first month, they had pre-orders that would total an estimated $14 billion of sales. That is the fastest commercial release. Partly that's simply because these are very, very good cars, no matter what the powertrain is. If they can capitalise on that, they don't have to sell all of those cars. This will make a really good return over the long term, but in the short term, the company's investing heavily. How do you think about that from an investment point of view? How do you think about how long you can hold through that? Lastly, Tesla also started making static batteries that you can put on the wall of your house that could be stacked up for factories to generate electricity. When you combine what happens in the alternative energy space, the improvements in, for example, solar panels, both in terms of the cost curve, but also in terms of the productivity that they can produce these days, that starts to look very attractive if you can generate power during the peak area of the middle of the day, but store it and use it at either ends. That changes the power dynamics. You don't need the network companies to distribute your power in the same way. You don't need the same sort of feed-in tariffs. Think about how that might impact, say, oil sales in the long-term future. One of the things that I wanted to highlight is it can be difficult to think about how fast change comes. So we were talking and we thought we'd run through the 20 years of the internet. So back in 1996, there was 36 million people, most of whom were in the US. Hotmail was a revolution as the first web-based mail. That was available in 1996 for the first time. Amazon was just starting out as a retailer in the book space alone and only listed in 1997. Fast forward 10 years. We have names that are more familiar. Google listed in 2004. YouTube came into being in 2005 and then was bought by Google in 2006. Facebook only listed as a public company in 2012. It was only the early 2000s that Facebook existed at all. Prior to then, we just didn't have social media. But really the game changer here was Apple in 2007 with the release of the iPhone and smart devices, because what that did was change the accessibility to the internet as well as the data that you could gather. You now had something that would give you location data that could be accessed anywhere in the world. And I'm sure it's familiar to everybody, the idea that while you're doing one thing, you're also on your smartphone or your smart device, that children seem to be permanently attached to them and incapable of talking to their friends another way. The addressable market, though, in 2006 was still only about 1 billion. Wind forward 10 years, and suddenly that's nearly half the world's population at 3 billion. The areas of our lives that it impacts is not just social media, but it's how we consume any media. So an estimate is about 50% of all digital media, that's music and videos, films, and now through things like the Amazon streaming service, through Netflix, how we travel has changed. We have Airbnb, we have Skyscanner if you want to look up a flight. There are new areas of e-commerce coming online that you can buy furniture, for example, through the internet. If you think about the change from 1996 to 2006, it was pretty big, but the change from 2006 to 2016 is an order of magnitude different. And what we're saying is when you're investing, it's important to think about that sort of exponential change. How fast can this move? Because it's easy to take it for granted. But actually, it wasn't that long ago when we didn't have smartphones, when a BlackBerry and messaging between people who had another BlackBerry was about as good as it got outside of the office. So what happens in the future? Driverless cars, based on the data feedback and all the sensors and the processing power they have. It's possible. AI assistants helping run your life. Your smartphone won't just dictate your life. It will absolutely run, organize, buy things for you, book things for you, as well as be your main data source. Virtual reality. Will you actually be able to communicate with people in a completely different way? Think about the step change in being able to do video calling versus a telephone calling that has come through the likes of Apple FaceTime and Skype. What's the next step change there, and how might it impact some of the existing companies? So doing this is a very exciting area to be involved in. It's nice to be able to talk about companies in terms of their long-term plans that actually will make a big difference, not about whether they're going to hit their quarterly earnings targets. That really makes a difference. It's simple, but it's not easy. This is about investing in individual businesses. This is not about speculating on short-term share price moves. You have to, as I said, engage with management. If you want to know what's happening in genomics, you need to be speaking to Jay Flatley of Illumina, because it's his company that's helped underwrite those changes. He is in the best place to do it. If you want to know what's happening in e-commerce in China, speaking to Jack Ma is quite important, because he's driving that. It's his company that owns 70% market share. Similarly, Jeff Bezos in the US and here in Europe is driving the changes that are coming through in e-commerce. Lastly, reputation matters. So if as an investor you want to go and talk to these companies, they want to know that you're serious about earning companies for the long term, that you're not just simply going to speculate on the share price moves and leave in the next quarter. So owning Amazon in large size for 10 years really makes a difference, because it means other companies notice that and they want to talk to us. That gives us insights that isn't available just through talking and reading analyst reports on companies. There is a shift in the capital markets. So some of these companies, I won't go into the details, have an access to capital in the private as well as the public markets. They need less capital to grow in the first instance. Through the power of the internet, they can now reach 3 billion people. There isn't the same geographic constraint. They can rent the expensive server capacity from Amazon Web Services. They can use free data bundles from other providers, meaning that they can build their businesses and scale very quickly with relatively little capital. That changes the provision between those who have capital and those who want it. And what we find is that those companies want to run their businesses for the long term. Like Jeff Bezos, like Mark Zuckerberg, they don't want to think about quarterly earnings. They want to be there in 5, 10, 15 years, and they want to invest on that. And if it means that the quarterly earnings target is missed, then so be it. It's not really important in their time horizon. One of the benefits, as we've already heard, of an investment trust structure is that there is liquidity within the investment trust's own shares trading on the market for you as investors, whilst there is a closed-ended pool of capital that gives us the ability to be patient holders of companies through what undoubtedly will be short-term volatility in markets from time to time. So a final thought for you as investors, but really this applies right across the board. Costs matter. Costs erode compounding returns over time. Think about how much you're being asked to pay. There needs to be a fair share. Patience pays off in the long term. One of the most powerful forces is the compounding returns over the long term rather than trading in and out of shares for the short term. I'm told I have 1 minute left, but I think I'll finish.
Thank you very much.